Senate Committee on Banking, Housing, and Urban Affairs will come to order. Today's hearing is in the hybrid format. Our witnesses are in person. Members have the option to appear either in person or virtually. The tragedy and the uncertainty of the coronavirus pandemic taught us a lot about the economy and the stock market. At first, for a brief period at the beginning of the pandemic, the stock market tracked what was happening in the rest of the economy. Small businesses and families struggled. U.S. stock markets suffered the fastest drop in history, plummeting 34% in 33 days. But then the stock market had the fastest rebound in history, recovering all of those losses by mid-August. Meanwhile, small businesses are making impossible decisions about layoffs or shutting their doors altogether. 14 million Americans were unemployed. Last year, we saw record highs in the stock market, all-time records in initial public offerings, private equity, venture capital. A story just came out that U.S. corporations had their most profitable year since 1950, yet continue to raise their prices. All of this was a reminder of what most Americans already knew, that the stock market is detached from the reality of most people's lives. It disproportionately benefits the wealthy. No news there, even in the Senate Banking Committee. According to Federal Reserve data, the wealthiest 1% hold 53% of stock in mutual funds investment. The bottom 90% own less than 12%. Think about that. 1% of the country holds more than half of all Wall Street assets. It's no surprise that most Americans don't trust the markets any more than they trust the banks. They don't think the stock market is fair. They think the wealthy and well-connected cheat the system, and the facts are on their side. Too often they're right. It's why today we're examining how Congress must work to crack down on bad actors who cheat the system and cheat Americans planning for the future. Everyone on Wall Street should play by the same rules. We know that's almost never the case. Right now, it seems too easy for corporate insiders out on a golf course in Florida or any other state to exchange information about upcoming mergers and deals and then mostly get away with it. Too often we see insiders from boardrooms to bankers involved in suspicious trading. These are people who should know better, people who know when they're crossing the line. They just can't seem to help themselves. The SEC, the Department of Justice, have prosecuted insider trading for decades using principles of fraud under the securities laws. Most of those principles have developed without a standard defined by Congress. Most people would probably be surprised to learn there's no one law written down anywhere that spells out what constitutes illegal insider trading. Over the years, federal courts have disagreed on what types of misconduct are in fact illegal, and when the Supreme Court has stepped in, instead of resulting in a clearer understanding of the law, it's created more confusion on what counts as illegal insider trading. We should all want strict, clear rules on what constitutes illegal insider trading. We should all want a statute that spells out when someone crosses the line. That would help avoid this uncertainty and consistency. Since 2014, there's been a debate between the federal circuit courts and the Supreme Court about when people who provide or receive insider information and trade on it, when they are liable for insider trading. After the back and forth in those cases, experts still disagree on how much the law changed, where the lines are, and what happens if the courts disagree in the future. We've also seen that there may be limits to our ability to use insider trading case law to hold new varieties of improper trades accountable. This is especially true with the rise of cyber threats. For example, if someone deliberately hacks into a computer system to access inside information, then trades on it. Existing statute and case law, believe it or not, don't always treat that as wrongful insider trading, even though pretty much everyone, it sounds like textbook example. Our colleagues in the House have been considering these gaps. I particularly thank Representative Hines, who's been leading on this issue for years. He's pushed legislation that would take away the uncertainty created by the courts and establish standards that address the questions that come up repeatedly. Our colleague on this committee, the senior member of this committee, Senator Reed, introduced S-3990, a Senate version of the House-passed bill that our witnesses will, in fact, discuss today. Insider trading cases might not be as cut and dry or as exciting as we see in the movies, but the same kind of misconduct and suspicious trading happens again and again and again. It's wrong. It's unfair. It's yet one more way that the wealthy and the well-connected game the system to get ahead. It's funny how the people who seem to have the best luck playing the stock market so often happen to have friends in high places. How shocking. We hear all the time about insiders who have amazing timing, buy stock days before a big announcement, or we read about the chain of people who share a stock tip, clearly confidential information that shouldn't be shared or traded on. Congress has finally the opportunity to make it clear what the rules are. The statutory definition of insider trading would capture abuses and misconduct, like hacking to steal confidential stock information that courts have found to be outside the concepts of fraud and deception. Even if the hacker assessed the information because of a security weakness, that doesn't mean what that hacker did is okay, and it shouldn't mean that hacker should keep his, usually a him, should keep his ill-gotten profits. The measure we're discussing today closes that gap by focusing on wrongfully acquired public information. Well-connected people buy sophisticated derivatives on a company's stock on a Friday. The following Tuesday, the company announces a merger. To most people, that doesn't sound just like a lucky bet or a coincidence. That sounds more like a wink and a nod and a you scratch my back, I'll scratch yours understanding. And when that happens all the time, it's no surprise that most Americans don't think they can trust the market with their retirement savings. For the vast majority of people who get their income from a paycheck, not a brokerage account, they don't see it as a way to make money. Families saving for the future deserve to know Congress will protect everyone who invests to send their kids to college or to buy a home one day. We must make sure our laws are written down, they're clear, they apply to everyone, no matter how powerful, no matter how wealthy. Senator Toomey.
Thank you, Mr. Chairman. I will address insider trading, but first I'd like to acknowledge that it was 10 years ago to this very day that President Obama signed the Jumpstart Our Business Startups, or JOBS Act, into law. This remarkable piece of bipartisan legislation opened new avenues for companies to raise capital. For example, it created a streamlined path for new startups to go public as emerging growth companies. Since 2014, these emerging growth companies have accounted for almost 90% of all initial public offerings, or IPOs. Yet despite that, the number of public companies continues to decrease. In fact, the number of public companies has declined 40% since its peak in the late 1990s. If not for the Jobs Act, the situation would be even worse today. This decrease in public companies hurts economic growth, cuts off funding avenues for American businesses, and reduces investment opportunities for average Americans. Although the last 2 years saw more IPOs, this may be an aberration if the large number of SPAC offerings turn out to be a temporary phenomenon. And if last week's SEC proposals on SPACs becomes final, we may see the end of SPACs altogether. But investors have been clamoring to be part of SPAC offerings, and we ought to ask the question, why is that? My view is that they want growth stage investments, and it's hard to get them any other way. Companies face excessive costs in going and staying public, which discourages them from going public in the first place. IPOs used to be a capital raising event. Now they're too often just a liquidity event for early investors. These costs of going public will increase substantially if the 23 SEC proposals announced in only the last 4 months, and many that significantly uproot the historical approaches taken in securities regulation, go into effect. For one of the proposals, just the one on climate change, the SEC estimates the SEC estimate is that it will nearly triple the external costs for companies in preparing their annual 10K reports. Imagine that. Think of the money companies spend today on preparing annual reports to cover the entirety of their business. The SEC would nearly triple that cost to add often immaterial disclosure requirements regarding climate change. In my view, the SEC is taking disclosures in the wrong direction. Unless we change that direction, we could lose America's #1 position as the leader in active and efficient capital markets. That's why yesterday, with my colleagues on the Banking Committee, I've rolled out a discussion draft of the Jobs Act 4.0. This draft is a result of a request I made last February for proposals to increase economic growth and job creation by facilitating capital formation. In response, we received 35 submissions with more than 150 legislative proposals from a wide variety of bipartisan organizations and stakeholders. We turned a number of these proposals into bills, a number of which have received bipartisan support. These bills encourage companies to be publicly traded, particularly during early growth stages. They improve the market for private capital by appropriately tailoring regulations for small businesses. They would enhance retail investor access to investment opportunities and improve regulatory oversight. We're seeking feedback on this draft over the next 60 days, and I'm hopeful that Republicans and Democrats can come together and find an agreement on a new Jobs Act 4.0. This draft acknowledges the important role played by private markets and how they can be improved. Now, some resist improving private markets because they claim that doing so would discourage companies from going public. But if we want to encourage companies to go public, maybe the answer is to make it less onerous to be a public company. I don't believe that any one type of market, private or public, is inherently better than the other. Indeed, the optimal source of capital for a company might vary at different stages of its growth cycle. Improved private markets can help private companies stay around long enough to grow into public companies. However, as the pool of public companies shrinks, retail investors are cut out of a key investment opportunity. We should expand retail investor access to these non-public investments so that they can diversify their portfolios and potentially receive the higher returns available to the wealthy. We know that union pensions, other institutional investors, and high net worth individuals routinely include non-public investments such as private equity and venture capital as part of their diversified portfolios. We ought to be ensuring that pension plans like CalPERS and wealthy investors aren't the only ones with access to these types of investments. Now let me turn to insider trading. The securities markets certainly are at the heart of our economy and our financial system. They reflect the collective decision-making of many individuals on whether to buy, sell, or hold securities, and in doing so, they carry out the critical function of price discovery. An accurate market price, one that efficiently incorporates all available public information, is perhaps the most important investor protection that exists. Thus, it is crucial that market participants have incentives to use lawful means to discover information, conduct analysis, and develop investment hypotheses, and to use those efforts to make better decisions about market prices. For that reason, insider trading has never been about one market participant having better information over another. Instead, insider trading is about one person wrongfully obtaining or using material non-public information in breach of a fiduciary duty or through misappropriation. In the decades since the first insider trading cases were brought, the courts have developed an extensive body of insider trading law. In my view, it would be preferable for Congress to codify what that law should entail. If we do so, we should be cautious about legislation that could cause confusion, uncertainty, or unintended consequences in this highly technical area, particularly regarding investment research. I look forward to hearing from today's witnesses about all of these important issues. Thank you, Mr. Chairman.
Thank you, Ranking Member Toomey. Senator Toomey and I are having a meeting later this week, and I'll take a look at these proposals, and I know that the Ranking Member and I would, on these bipartisan legislation, that we can perhaps move forward on making housing more affordable and accessible and strengthening our communities and looking at the Jobs 4.0 Act. I'll introduce today's witnesses. Professor Robert Jackson, Jr. is the Pierrepont Family Professor of Law and co-director of the Institute for Corporate Government and Finance at the NYU Law School. He was nominated and unanimously confirmed by the Senate to be an SEC commissioner back when the Senate did things in those ways in December 2017. Professor Todd Henderson is the Michael Marks Professor of Law at the University of Chicago, studies corporate and securities law. He's an expert witness in securities fraud litigation on the subject of insider trading. He served as a judge, a national adjudicatory counsel at FINRA. Mr. David Burton is the Heritage Foundation's senior fellow in economic policy. He focuses on tax matters, securities laws, entrepreneurship, financial privacy, and regulatory and administrative law issues. He was general counsel at the National Small Business Administration before joining Heritage. Professor John Coffey is the Adolf Berle Professor of Law at Columbia Law School and director of their Center on Corporate Governance. He served as a member of the Barara Task Force on Insider Trading. Professor Jackson, please begin your testimony. And understand, all of you, there will be 2 votes during this committee, so people, including the Ranking Member and I, will be a little more up and down than we would like to be at this hearing. So proceed, please.
Well, thank you, Chairman Brown, and thank you, Ranking Member Toomey, for the opportunity to testify before you today. You know, the last time I had the honor of testifying before this committee, it was at the hearing on my nomination to be a commissioner of the Securities and Exchange Commission. And my mom and dad, who grew up in big Irish Catholic families in the Bronx, you know, my mother's one of 9 kids, my father's one of 5, proudly sat behind me that day. And the day I was born, none of my family had been to college. But my parents plowed their paychecks into the market, and 40 years later, they sat behind their son as a presidential nominee. So to me, markets are important not only because they encourage entrepreneurship and growth, they're important because they make it possible for two middle-class parents to change their son's life. And we owe it to families pursuing their vision of the American dream, just like mine did, to make sure that when they invest in our markets, they do so on a level playing field. And that's why, after I was confirmed to be a commissioner, I joined Preet Bharara, the former United States Attorney for the Southern District of New York, in calling for a national task force on the law of insider trading. You see, because Congress has never codified insider trading rules, both defendants and ordinary investors like my mom and dad are exposed to gaps in our law. The task force, featured a bipartisan group of prosecutors, defense counsel, legal academics, and judges, concluded that Congress should clarify the law of insider trading, and I agree. That's why the Insider Trading Prohibition Act you are considering today is so important. As the task force urged, the act would focus liability on whether information was wrongfully taken, used, or communicated. And for a detailed and thoughtful analysis of those provisions, I commend to you the testimony of my colleague, Professor Coffey, and his writing on this subject. My testimony will identify two additional gaps in current law that make clear the urgent need for this legislation. First, current law allows cyber hackers to profit from trading on their activities. And second, insiders at foreign firms listed in the United States, and particularly Russian and Chinese firms, profit extensively from their trading, putting American investors at risk. As this committee knows too well, our companies are in a constant battle to protect themselves from hackers who seek access to millions of Americans' most private information. And there's concerning evidence that these hackers not only attack our companies, but also trade before the attack is public, raising the prospect that our very markets help finance the cyber attacks that put Americans' privacy at risk. And as it stands today, the law of insider trading often doesn't cover that activity. The reason is that establishing insider trading liability under current law generally requires the government to show that the information was obtained by breach of a duty or by way of deception. But you see, many hackers attack our companies not through deception, but by brute force tactics that simply overwhelm our defenses. Now, from the perspective of the judges who made our insider trading law, that distinction might make a difference. But for ordinary investors like my mom and dad, the idea that the law of insider trading allows hackers to profit from the destruction they cause raises doubts about the fundamental fairness of our markets. And this act would close that gap. Among the most significant impacts of the law would be to clearly outlaw trading on information obtained through cybersecurity attacks. And closing gaps like these is all the more urgent in today's fast-moving markets, where traders are constantly looking for advantages against ordinary investors. And in a study released last week, my co-authors and I examined another such gap: insider trading by executives at foreign firms listed in the United States. As this committee knows, foreign companies domiciled in China and Russia now raise significant funds from American investors by listing on U.S. stock exchanges. Unlike executives at American companies, however, insiders at foreign firms are not subject to prompt disclosure of their trades in their company's stock, raising the risk that our outdated insider trading law allows foreign firm insiders to take advantage of ordinary investors. So Daniel Taylor and Bradford Lynch of the Wharton School and I dug into the data. Drawing on a unique data set based on thousands of paper filings with the SEC describing sales of stock over a 5-year period, we study whether foreign firm insiders are able to avoid losses on U.S.-traded stocks by selling in advance of price declines. And the results are striking. Our data provides systematic evidence that foreign firm insiders avoid substantial losses by selling shares before the stock price drops. And this activity is concentrated in firms domiciled in just a few countries overseas. When insiders of U.S.-listed Chinese companies sell shares, their median company's stock price falls by 23% in the 12 months after that sale. And when insiders at U.S.-listed Russian firms sell, the median firm's stock declines by 21%. These sales allow foreign firm insiders to avoid significant losses in dollar terms. Indeed, we estimate that insiders at Chinese-domiciled U.S.-listed companies have avoided over $10 billion in losses as a result of well-timed stock sales. It's far from clear why foreign firm insiders should be playing by a different set of rules than their American company counterparts who must disclose their trades promptly to investors. And that's why the SEC should reconsider foreign firms' exemption from the insider trading disclosure rules companies must follow under the Exchange Act. For decades, the judge-made law governing insider trading has left gaps inviting insiders to take advantage of ordinary investors. And Congress should make clear that all participants in our markets must play by the same rules. Thank you for the opportunity to testify before you today, and I'd be delighted to answer your questions.
Thank you, Professor Jackson. Professor Henderson, welcome.
Thank you, Mr. Chairman and members of the committee. For a kid from Appalachia, this is a great honor to me to be in the world's greatest deliberative body, so thank you for having me. It's an important topic. We're talking about capital raising and insider trading. These issues, as the ranking member said, are at the heart of our economy. Every company has to raise money, and laws and regulations have a tremendous impact on how this is done, and more importantly, how much it costs. It's easy and maybe politically appealing to add more and more obligations on companies, but the costs of compliance don't just fall on rich investors and abstract companies. They're paid for by every American. While we need laws to prevent fraud and ensure accurate disclosure of information, every dollar spent on complying with regulations is a dollar not spent on employing workers, investing in research and development, and in bringing products and services to everyday Americans. The goal of law should be to obligate companies to spend no more than absolutely necessary to protect investors and ensure robust capital markets. After all, we all pay for regulation, and we should only be willing to do so if the benefits exceed the costs. There's no real question that the costs of fundraising are too high today. The burdens of securities disclosures are many times higher than they were just a few decades ago. To give just one example, disclosure obligations under Regulation SK, it has 102 specific items set forth in over 140,000 words on 385 pages in the Code of Federal Regulations. These rules have grown 20 times in length since 1980. This means lots of lawyers can find work, which is fine for me as a law professor, but fewer engineers, chemists, and others who actually discover things that improve the lives of people. The risk of meritless securities fraud suits also remain high despite Congress's effort to eliminate them. The result has been a sharp drop in the number of public companies. There are about half as many today as there were in 2000. And companies are also resorting to new ways to raise capital like SPACs as a workaround around going public. And while the verdict is still out on SPACs, the fact that such innovation is viewed as necessary by investors and companies should give regulators pause before piling on new costs of going public through traditional means. Instead of trying to reduce the burdens on public companies, the SEC is doubling down, issuing proposed rules that will straddle investors, workers, customers with more costs. At the same time, it's hampering the ability of all Americans to invest in private markets. Private companies are an important alternative to public ones, and returns in private equity markets and other alternative asset classes have been superior to public returns in recent decades. This is not only an important investment opportunity, but for investors of all kinds, but it helps turn around struggling companies, offers all companies an alternative governance approach that can meet their needs at various times, and most importantly, provides discipline against public company managers that may act in self-serving ways. Congress and the SEC should expand the opportunity of every investor to access private equity and other asset classes consistent with fiduciary duty obligations under ERISA. Let me turn briefly to insider trading. When we're talking about insider trading, it's important to put aside the conventional wisdom that it's unlawful to trade based on material non-public information. Investment advisors and stock market analysts make their living seeking informational advantages for their clients. Without these incentives, there'll be less information about stock prices, which means stock prices will be less accurate. The consequences will be capital will not be allocated to where it's most valuable. This harms everyone, not just investors. Insider trading based on informational advantage is only illegal when it results in a violation of the anti-fraud provisions of the federal securities laws. Under existing case law, that generally happens when a corporate insider trades on material non-public information for his benefit, when someone deceptively takes non-public information that doesn't belong to them and uses it to trade, or when individuals provide, like a tipper, the material non-public information to someone else in return for a personal benefit. Justice Ginsburg made this property-based approach clear in her opinion in United States versus O'Hagan. The Insider Trading Protection Act purports to merely codify this existing law, but it goes way further than this. When law professors can turn everyday scenarios, like overheard conversations about deals and documents left in the back of airplane seat pockets, into challenging law school hypotheticals, the result will be a huge chilling effect on the necessary work to ensure accurate stock prices. This means not only the opportunities for misallocation of capital, but also large compliance costs for investment funds. Importantly, these costs of ensuring investment professionals do not violate the law will fall disproportionately on smaller and mid-sized investment funds. To make matters worse, these funds are likely to be owned and operated by women and minorities, and likely to be the ones taking alternative positions on things like ESG and other related matters. There are a few problems with the ITPA in its current form. It purports to codify the existing personal benefit requirement for the tipper, but includes the language indirect personal benefit. It's possible to describe virtually any human interaction as providing an indirect benefit to participants. Instead, the law should reflect the common sense notion that the source of information either receives something tangible and valuable in return, or provided something like a monetary gift to a relative or friend. Second, the Act uncontroversially states trading on information wrongfully obtained by theft, deception, and so on will lead to liability, but it contains a very broad provision about confidentiality. This is a system ripe for abuse, with companies potentially able to prevent investors from trading merely by providing them with information they don't want. Third, it expands the type of traders who could be held liable for insider trading. Currently, a trader has to act with some intent to violate the law. Under the bill, however, anyone who was, quote, aware, consciously avoided being aware, or recklessly disregarded the information was wrongfully obtained or communicated can have a case brought against them. The ITPA is silent on what recklessly disregarded means, which would appear to rope in innocent traders along with actual wrongdoers. Finally, the ITPA does not contain an exclusivity provision. There is a provision of federal criminal law, 18 U.S.C. 1348, which the Department of Justice has used to criminally prosecute cases of insider trading where there was no personal benefit. Without an exclusivity provision, the government will just use that provision, avoiding the entire ITPA to bring cases. So the ITPA should include an exclusivity provision. There's little dispute the knowing use of material non-public information is wrong. It's known as stealing, and that's what the government should be trying to prevent. At the same time, we don't want to chill the valuable communications that go on between company insiders and market participants, which provide investors with important real-time information about their investments. This is an opportunity for Congress to establish insider trading provisions with a clear set of limited roles that we should follow, but the law should be changed to clarify what a personal benefit is, drop the catch-all provision about wrongfully obtained information, require an actual knowledge requirement, and make it the basis for the exclusive basis for bringing insider trading claims. Thank you for your time.
Mr. Burton.
My name is David Burton. I'm Senior Fellow in Economic Policy at the Heritage Foundation. I'd like to express my thanks to you, Mr. Chairman, Ranking Member Toomey, and other members of the committee for the opportunity to be here this morning. Because today is the 10th anniversary of the 2012 Jobs Act, a bipartisan achievement of consequence, I've been asked to focus on entrepreneurial capital formation issues in my testimony. Specifically, my written statement addresses the importance of the original Jobs Act, the importance of entrepreneurial capital formation to the economy and the American people, the importance of regulatory impediments to the entrepreneurial capital formation, and legislative proposals that have been introduced this Congress and been incorporated into the Jobs Act 4.0 discussion draft. In addition, I discuss a number of statutory improvements that this committee may want to consider, and some fundamental reforms of securities laws that could help entrepreneurs, larger public companies, and the return to investors. The 2012 Jobs Act has had a measurable positive impact and improved entrepreneurs' access to capital. Jobs Act offerings account to 3 to 7%, depending on the year, of private capital raised. In addition, the emerging growth company provisions included in Title I of the Jobs Act arrested the precipitous decline in IPOs, initial public offerings. And since then, they've been largely flat. The Jobs Act made 5 basic changes to the law. They fall into 5 basic categories: smaller public emerging growth companies, or EGCs, general solicitation under Regulation D, crowdfunding, and improved small issues exemption, often called Regulation A+, and changes to the registration threshold, allowing more companies to remain private. Title I, relating to emerging growth companies, was a major contributing factor in stopping the decline in IPOs. Title II, permitting general solicitation of Regulation D offerings, resulted in Rule 506C, and this has helped companies raise $65 to $200 billion annually. It's a major and underappreciated success. Title III crowdfunding has largely been a failure because of the underlying statute and major regulatory piling on by the SEC. Both the tiny crowdfunding issuers and funding portals are significantly overregulated. The SEC revisions that took effect last March may help reduce this problem, but they're not going to solve the underlying problem. Title IV, Regulation A+, is a modest success. It currently is used to raise about $1 billion annually. Some relatively straightforward changes, the most important of which is addressed in the discussion draft, could make Regulation A a much more important source of entrepreneurial capital formation. The legislative proposals incorporated in the Jobs Act 4.0 discussion draft would, as a package, dramatically improve entrepreneurs' access to capital, and improve investor protections and returns. The legislation would remove restrictions on secondary market sales that seriously impede the ability of investors to recognize full value for their investment. It would democratize access to private equity markets, enabling more investors to diversify their portfolios and achieve higher returns. And it would make major improvements to the rules governing emerging growth companies, Regulation D, Regulation A, crowdfunding, micro offerings, finders, exchanges, periodic disclosure requirements by issuers, business brokers, small broker-dealers, investment companies, retirement plans, and many other areas. It is an extremely constructive piece of legislation that would genuinely improve people's lives. And I don't have the time right now to address all the positive aspects of this legislation. I would specifically like to talk about the SEED Act, which creates a micro-offering exemption and would have a very positive effect on the smallest companies in the United States. The Unlocking Capital for Small Business Act is a well-drafted piece of legislation that addresses a major problem created by the SEC and is underappreciated in Washington. It would help the smallest entrepreneurs access capital found in money centers using finders and private placement brokers, potentially helping tens of thousands of small businesses each year or more. Similarly, the Small Business Mergers, Acquisitions, Sales, and Broker Simplification Act will clarify the rules governing broker-dealers. The Equal Opportunity for All Investor Act is an extremely constructive piece of legislation that would democratize access to private offerings. Section 308 of the bill relating to retirement savings modernization would make it clear that at-risk fiduciaries managing defined contribution plans can invest in private equity and other assets. And there's a host of other very constructive legislation in this discussion draft. In my written remarks, I made a number of suggestions for additional reforms. I look forward to working with the committee on these matters. The discussion draft is very important legislation, and the process that you've begun will result in a strong, well-thought-out bill that will help millions of Americans. Thank you.
Thank you, Mr. Burton. Professor Coffey, welcome.
Fellow members of the committee, thank you for inviting me. I expect you're going to be happy to hear that I'm going to radically condense my written testimony to focus on just two questions. One, what is right with this bill? And there is much that is right with this bill. And what is wrong with this bill? And there is one thing that is tragically wrong with this bill, because it will be a backward step that will permit all professional traders, hedge funds, and other active investors to trade on large amounts, counseled by their counsel, so that they will never be involved with a personal benefit. Once you impose the personal benefit requirement, it can be outflanked by sophisticated parties, and it will be impossible to prosecute them, and accountability will be lost. Let's go first to what is right with this bill. It is overdue to have legislative codification of this bill. Insider trading was defined by the SEC in 1961 in the K.D. Roberts decision. It's over 60 years ago. Since then, there's been a constant dialogue between the SEC and the courts. Sometimes the courts have cut the SEC back. Sometimes they've tolerated various expansions and outflankings. But Congress has been totally left out of that conversation and dialogue. Yes, Congress knows it's against insider trading because it keeps raising the penalties periodically, and that shows their position. But the consequence of this kind of development of a common law crime through judicial interpretation is that courts treat insider trading much like they would treat a common law tort. They constantly expand it at the margins more and more, and it grows over time. Okay? Once that happens, you have greater disparity among the circuits. There's high disparity now. Some circuits require personal benefit. Some, like the Second Circuit, where most of the action is, does not today. And you can't really end that problem by passing the statute, because as Professor Henderson properly pointed out, there's another statute, 1348, which allows you to prosecute securities fraud and insider trading, and makes very clear that when it was passed as part of the Sarbanes-Oxley Act, that it did not intend to impose many requirements. It greatly simplified these prosecutions, and thus the courts have upheld that. Several decisions have said that, but the most important is Blazek, which right now has been remanded on a different issue back to the Second Circuit. You could write a statute that says 16A is exclusive. I think that would be much too quick and much too rash because there are all kinds of implications, and we don't know what's going to happen yet when the Second Circuit deals with the Blaze Act decision on remand from the Supreme Court and what the Supreme Court would do after that. So it would be legislating a little hastily to make this statute exclusive. But if it's not exclusive, prosecutors are not dumb. There's a hard route and an easy route. They will take the easy route, and that's 1848. Now, let me go from what was right with the statute, and I haven't touched half the things that are right with it. By the way, I'm biased in this because I did work with Congressman Himes on the original drafting of this statute, so I know the good things that are in there, and there are many. But what is wrong with it? And this is the personal benefit requirement. And what is wrong with the personal benefit requirement? Well, since this bill was adopted, was introduced and passed in the House, the Preet Bharara Commission, or task force, came out with this report on insider trading. It was staffed with judges, prominent prosecutors, prominent SEC enforcement attorneys, and a sprinkling of modest law professors, including myself. So I'm biased there too. But it said the principal obstacle to insider trading prosecutions today was the personal benefit requirement, and it applied particularly to the sophisticated traders that we most want to hold accountable. It made a recommendation. It said we got to get away from personal benefit and focus more broadly on wrongfulness. Wrongfulness would be the better alternative standard. Was this behavior clearly wrongful so the person that we are prosecuting would have been conscious of the wrongfulness of this behavior? That doesn't require you pay a bribe. When you look at the best-known insider trading cases, and the one that caused much of the consternation, which was the Newman decision, one hedge fund got inside information improperly and tipped another within seconds of its receipt. Actually, they tipped 3 or 4, but the other that was prosecuted made $72 million on that transaction, one day of trading. That's not small time. That's a big-time crime, and under this bill, it would be perfectly permitted to do this. There would be a royal road how you could successfully engage in insider trading. Why does this tipping occur among hedge funds? Very simply, because Wall Street is effectively a giant favor bank. There are norms of reciprocity among these activist hedge funds. If I tip you, you got to tip me, or we won't do it again. And in that world where everybody knows that you got to keep your deposits and your withdrawals in balance, we will have people tipping back and forth without a personal benefit. On that note, I'll just say again, I think you'd make a tragic mistake if you left in the personal benefit requirement. Thank you.
Thank you, Professor Coffey. I will start with you. The legislation we're discussing, Senator Reed's bill that updates Representative Hines' bill that you worked on, lays out a framework that bans insider trading and identifies when sharing insider information is wrongful and when trading insider information is wrongful. Why is it important, Professor Coffey, for Congress to target wrongful conduct?
Well, it's the alternative to focusing on personal benefit, which is overly narrow. Personal benefit says if you don't pay a bribe, you can do this, but you can do it without paying a bribe because there are norms of reciprocity in the world of people who interact regularly. And you do have personal benefit down there in standard 1D of this statute. All you got to do is take out 3 or 4 words for a direct or indirect personal benefit. Now, if those words were taken out, I would be happy to support this bill, which I worked long and hard on before it was initially introduced. But there was a last minute, within minutes of this bill being passed in the House, that change was made to put personal benefit back in, and I think it was ill-advised.
Thank you. A couple questions for you, Professor Jackson. Some argue the courts have addressed insider trading for so long that Congress doesn't need to legislate, but we've seen courts disagree on liability for insiders or tippers who pass on confidential information, and the recipients known as tippees who trade on it. How have these disagreements affected the enforcement of insider trading cases?
Well, thank you, Senator. I think this lack of clarity has caused real problems in the application and enforcement of securities law. You know, when I was an SEC commissioner, we often worried about whether the law was clear enough for us to be able to proceed against defendants, even when we were convinced that they had used information wrongfully. And the costs of that, sir, are real. There are cases that can't be brought. And when market participants know that we're not able to hold them accountable when they do something wrong like that, they tend to do more of it. So I think this lack of clarity has been a real issue. And I just want to be clear about something, Senator. The fact that the courts have spoken on the issue doesn't mean Congress shouldn't. Quite the opposite, sir. In my view, it is Congress that should speak clearly about what the law is in this area, drawing on the experience of the courts, to be sure.
Professor Jackson, illuminate this for all of us. Tell us, if you would, about common facts across insider trading cases that would indicate someone knows they are engaging in wrongful trading. Walk that through for us.
Sure. Well, a fact pattern we saw with surprising frequency that I saw when I was a corporate lawyer and that I saw as an SEC commissioner is when somebody in possession of material non-public information will buy short-dated, out-of-the-money call options, for example, taking advantage not just of the information that they have, but the ability to make as much profit from it as quickly as they possibly can. Often when we see that pattern, defendants respond that they were very lucky. And sir, at least I have not been the benefit of that kind of luck in my experience in the stock market. Nevertheless, this kind of activity is well known to the SEC and the courts, and candidly, we know wrongful trading when we see it, sir.
Professor Coffey, critics of the insider trading legislation suggest that it will criminalize everyday activities like stock research, accidental communications of confidential information, and expand the scope of illegal insider trading beyond its current limits. Is that a realistic reading of the legislation?
Not if you insert a clear wrongfulness requirement. I fully agree with Professor Henderson said. Merely the possession of material non-public information does not create a duty not to trade. It's only when you breach a duty, whether it's a duty to the shareholders, a duty to the source of the information, or a duty to the last tipper who told you, if you know that this was wrongfully received information, you're really in the same position as the classic fence in a theft case. Fences who receive stolen property knowing that this property was wrongfully obtained and acquired are going to be criminally liable for selling the property, moving it on. You can't receive stolen property. I don't think you can receive stolen information. Inside information that has been received by a breach of a fiduciary duty is really a kind of stolen information, and if there's consciousness of that, your behavior is wrongful. If you talk to lawyers in advance, you will make sure you don't ask for a personal benefit and you don't receive a personal benefit, and then under the personal benefit standard, you are immune. But you shouldn't be immune. If it's wrongful behavior because you had consciousness that this was stolen information, I think that is sufficient to justify prosecution.
Professor Jackson, you want to add anything to that?
Well, absolutely. I think one of the issues in our insider trading law, Senator, is that it just hasn't kept up with the way that markets work. You see, the idea that in order to prove a case against an insider trader who, or rather a tipper who's given information to an insider trader, that the government has to produce a bag of cash that she received in exchange for her secrets strikes me as both an unrealistic burden for the government to carry and also not the way information moves in our markets. As Professor Coffey explained, I think quite correctly, sir, the way information is shared in our markets these days is through an extensive system of conversations and favors among market participants, and the law can and should capture that when it is wrongful.
Thank you. Senator Toomey.
Thank you, Mr. Chairman. Professor Henderson, I get the sense that there's a little bit of a disagreement on the panel, that Professor Jackson and Coffey have a different idea of what the standard should be for liability, and I think that the distinction pivots on this personal benefit versus indirect benefit standard. So I wonder if you have a response to the arguments that they have made as to why you, if I remember correctly, do not believe the indirect benefit standard should be the appropriate standard, but also what would be the adverse effect if that were to become law?
Thank you, Senator. I have a lot of agreement with what they've said about cyber hacking and great respect, and I agree. I think the focus, as Professor Coffey said, should be on stealing. Professor Jackson said the SEC knows wrongfulness when it sees it. I am skeptical of that. The most famous insider trading case probably ever was SEC versus Dirks, where the SEC's view was that Mr. Dirks, who was trading on information revealed to him by an insider at a company that was running a giant Ponzi scheme, was wrongful, and they wanted to punish Mr. Dirks. taking information from a company that's running a Ponzi scheme that they had tried to tell the government on repeated occasions was a Ponzi scheme and nobody would listen, and trading on that information to move the stock price in the right direction, that's not wrongful conduct. It might be stealing from the standpoint of the company whose property has the information, but it's not wrongful in any sense. The SEC, frankly, their attitude for the last 5 decades has been to try to create a parity of information between traders, that people should trade based on the same information. And if that's the view of the commission and their idea of wrongfulness, I think that's a real problem. I think the idea that what Professor Coffey said, which is if someone steals information in return for some financial gain, and it doesn't have to be a bag of money, as Professor Jackson said, it could be a favor you're doing for someone knowing you're going to get something in return, something that you're doing this to serve your own selfish interests. That's a problem. That's just like stealing office furniture. We don't allow people to do that. If what you're doing is really not about serving your own personal interest, it's about revealing fraud within a company, then I think that's a completely different situation. This idea that we're going to have a property rights approach where the companies get to determine what the property is, I think is the wrong way to go. I think we should focus on the stealing, and I think we should say when people have motives to steal that are personal, self-serving, you don't need a bag of money. The government does have to show the burden, but if they can show the networks that Professor Coffey's talking about of information trading and groups of people in these activities, then I think that should be enough.
Thank you. Mr. Burton, we've had several observations about the huge decline in the number of public companies in America, despite the fact that we have more people, we have more businesses, we have a bigger economy, yet we have fewer publicly traded companies. Just briefly, what do you think the main reason is we have fewer public companies in America today than we did decades ago?
I think there are 2 related reasons. One is a massive increase in the regulatory burden of being a public company that's been ongoing for approximately 3 decades, and then is about to get radically worse if the SEC promulgates some of the rules that is recently proposed. The second reason is a substantial increase in litigation risk and the costs associated with either preemptively protecting yourself against that litigation or defending against litigation.
Could we go, with respect to the SEC's new raft of disclosure requirements, it's my understanding that for the first time, the SEC is going to require the disclosure about facts that are not financially material to the companies that have this burden. That strikes me as a whole new layer approach to regulation. I wonder if you have any thoughts on the wisdom of that.
Well, I think going down that path is a serious mistake, but they're in effect trying to redefine the way materiality has been understood for 8 decades. And the proposed greenhouse gas emission rule or climate change disclosure rule that was released about 2 weeks ago would literally triple the cost of being a public company. And that's going to have dramatic effects. It will make the going private transactions associated with Sarbanes-Oxley's internal control reporting requirements look like child's play. And then there are also, if you look at the OMB Unified Regulatory Agenda, there's a whole series of other similar type disclosure requirements in the pipeline relating to DEI or human capital management and so on down the line, which have either no relationship to the financial outcome of the company or a tangential relationship to the outcome of the company.
And that's a complete departure from the historical norm on the terms of the standard.
It is, and I think ultimately it may well, I know it will seriously undermine securities laws because it's at variance with its fundamental historical purposes of helping to provide material information to investors so our capital markets are more efficient and so that investors can make more informed investment decisions.
Thank you. Senator Menendez?
Thank you. Well, let me thank the chairman for holding this hearing. I also want to thank my colleague, Senator Reed, who's at the Armed Services Committee, for his tireless work to pursue legislation that we are working on together. He and I have been working to codify and clarify our laws regarding insider trading since 2015 when we introduced the Stop Illegal Insider Trading Act. I'm glad to be able to continue that work today with the discussion of our new bill, the Insider Trading Prohibition Act. And I believe this is common sense legislation that will provide much needed clarity and regulatory stability, as well as protections for investors. So let me turn to my questions. I believe that everyone is more or less in agreement that insider trading is unfair. And that, to me, is reason enough to clearly and explicitly ban the practice. However, I also want to push back on the idea that it is a victimless crime. One of the reasons I believe it's important to codify our laws against insider trading is that the practice has tangible negative effects on the economy. Professor Jackson, can you talk about some of the negative consequences of insider trading on markets and shareholders and the public at large?
Absolutely, Senator. Thank you. Our inability to enforce the insider trading laws and the limits of the judge-made doctrine that we have has very real costs for ordinary Americans. What it means is that when they enter our markets, they can't be as sure as they should be, sir, that they're going to be on a level playing field, but instead that they might be trading against individuals who have better information than they do for reasons unrelated to the actual underlying value of the stock, but instead because those individuals are in a privileged position, for example, in the senior management of the company. Those are very real costs that ordinary families face. And when they try to plan for their retirement or education, we should do better in making clear to them that when they put that money in the market, like my parents did years ago, they're going to be on a level playing field rather than trading against somebody who knows more than they do simply because they happen to work at the company.
Yeah, I think insider trading can increase market volatility and certainly reduce the confidence in markets and companies at the expense of shareholders, which is why I think it's important that we act. Let me ask you, one of the goals of the Insider Trading Prohibition Act is to clarify certain conflicts that have arisen in the courts. One such clarification is that this legislation makes it unlawful to trade securities based on information that the trader knows or has reason to know was wrongfully obtained, regardless of whether the trader knows whether a source breached a fiduciary duty or if they derived any personal benefit. Can you explain to the committee what led to the court conflict over personal benefits and why this clarification is important?
Absolutely, Senator. What happened in the courts is they were trying to understand when a tipper inside a company gives information to a trader, why she did that. And what they did was use the personal benefit approach as a way to understand whether she was personally getting something by giving away this information. And while in theory that sounds like a good idea, Senator, the problem is in practice, as I was suggesting earlier, the way financial markets work is that people don't trade information for bags of cash. No, they trade information, as Professor Coffey has explained, in relationships, conversations, trading favors, et cetera. That's the way information passes in our markets today. And if we make the government prove that they handed over cash in order to give up their secrets, what that really means is that we won't be able to bring those cases. And as you pointed out, Senator, what that means is that ordinary Americans can't be sure they're getting a fair deal when they invest in our markets.
Okay. So I raised this point. Thank you for your answer and your insights, because it exemplifies what the legislation is all about. It's about making sure that the law is clear, that it resolves existing ambiguities and covers the full range of practices that constitute insider trading. If someone knowingly trades on inside information, it shouldn't matter whether that person shared the information, violated a duty or received a benefit. And finally, one question Congress has been grappling with is how to fit digital assets into existing financial and regulatory frameworks. Though our bill doesn't directly deal with digital assets, it's important to consider how these assets might interact with insider trading regulations. Dr. Coffey, what concerns, if any, do you have regarding insider trading in the digital assets?
Right now, of course, the securities laws do not apply to cryptocurrency as such. That does apply to certain initial public offerings of cryptocurrencies. It's a funny distinction. But I do think that it's a Wild West out there in terms of cryptocurrencies. We don't know what's going on, but it's extremely volatile, and people are making or losing billions, and I don't want the small investor getting into that until the market is cleaned up and the West becomes a somewhat tamer place. Okay? That's the world of cryptocurrencies. I just want to emphasize what the professor, what my colleague was saying a minute ago. The Bahara report is not for making strict liability. It's not for making insider trading very easy to prosecute. It is instead saying using only the personal benefit standard is under-inclusive. Properly counseled by good lawyers, hedge funds can avoid making a payment or promising a payment, and then they are immune if you use the personal benefit standard. What you should instead use, and I think this is a representative body, the Bahara Commission, said we should instead use a wrongfulness standard. Did the parties know they were behaving wrongfully? When you tell someone else, we just got word, Dell's going to reduce its earnings by 50%, it'll be announced the day after tomorrow, and the two hedge funds trade like wild and make, in the case of the Newman case, something like $72 million in that one day, I think that's the kind of behavior that I can say shows wrongfulness. And if you want to add a little bit more to the statute to make that wrongfulness requirement even clearer, we are not suggesting strict liability. We're suggesting if you behave wrongfully but don't pay a clear bribe, you can still be held liable. If you don't say that, you created a royal road for hedge funds to get very rich and behave very badly.
Thank you. Senator Tillis.
Thank you, Senator Menendez. Thank you all for being here today. Mr. Burton, one question I have for you is I think there are a lot of hardworking Americans that find themselves on the outside looking in, especially when it comes to opportunities to invest in a deep and diverse pool of young companies with significant growth potential. So I and a couple of my other colleagues believe it's important to update the rules of the road so more everyday Americans, and not just large funds, can chart their own economic path as early stage and accredited investors. Senator Scott and I introduced a bill called the Equal Opportunity for All Investors Act, and the legislation updates the laws on accredited investor status to allow examinations and subsequent self-certifications for accredited investor status. Do you think that increasing access to early growth companies are an important way to democratize investing?
Absolutely. I believe your legislation is extremely constructive legislation. It'll give less affluent investors access to high-growth companies, enabling them to achieve higher returns and also diversify their portfolios and make it so that the securities laws basically don't set up the system so that only rich or very affluent people can participate in these offerings. And that's, I think, a very important step forward. The other thing I mentioned is the fact that you allow people to test into the status by demonstrating investment knowledge gives life to something that's been in Regulation D since its advent, namely the conception of a sophisticated investor. But because people don't really know what it means, it's not used very often, and the bright line thresholds relating to income and net worth are used instead. So that would enable someone who actually is sophisticated to demonstrate that by taking a test administered by someone like FINRA.
Anyone wishing to speak in opposition? Mr. Robert?
Well, thank you, Senator.
I like creating a debate format from time to time, particularly when there's not a lot of members here.
Thank you, Senator. Certainly, it's important to give people opportunities to raise capital, sir, but I was actually very pleased to see that part of the package that's been rolled out includes an issue in the cost of raising money that hasn't been addressed by the SEC, and that's the tax that small and mid-sized companies pay when they go public to Wall Street. You know, sir, for 20 years, there's been clear evidence in the finance literature that when a small or mid-sized company goes public in this country, they give 7% of what they created as entrepreneurs over to Wall Street. Not 6.5%, not 7.5%, but exactly 7%. It's not my experience, sir, that competitive markets set prices at the exact same level for 20 years in a row. When I was on the SEC, I called for us to study this and ask, why do small and mid-sized companies in this country have to pay this tax on the toll road to go in public? And I was delighted to see that part of this package is going to ask the SEC to study that question and get after why it's so expensive for small and mid-sized businesses to raise capital in our markets.
Mr. Burton, 45-second rebuttal.
Well, he's absolutely right on the aspect that we need to study the costs associated with initial public offerings. We need actual better information from the SEC across the board. I work in a number of different fields, and the Department of Labor, the Internal Revenue Service, the Commerce Department all put out a great deal of information every year so we know what's going on in that area. The only place where that isn't true is the Securities and Exchange Commission. And we talked about that a little bit when you were a commissioner. Basically, the SEC is extraordinarily bad at providing information to policymakers like yourself, and we need to fix that. In terms of your legislation, specifically on amending the accredited investors, not only will it democratize access to these private placements, it'll also help entrepreneurs, particularly in rural areas or smaller states, because if you live in Washington, an entrepreneur is likely to know a tremendous number of accredited investors. If you live in a smaller community where incomes and net worths are lower, you don't have access. And I think typically people here in Washington don't focus on how rare accredited investors are in much of this country. And your legislation will help address that disparity.
I'm about to run out of time, but one question, Mr. Burton, I may just see if I can get your response. A question for the record. I've worked on the Reporting Requirements Reduction Act, which had to do with going from quarterly to semi-annual reporting. I think that you've expressed maybe some, if not concern, but expressed some opinions that I'd be very interested in. But I still believe that we need to right-size regulations. Yes. And you're talking to a former partner, PricewaterhouseCoopers, who built a big firm that had a lot of regulatory compliance. But I think it would be nice to be able to lower the temperatures here, because when we're talking about right-sizing regulations, I'm not talking about walking away from something that's a real risk that needs to have oversight, but doing it in a tailored, more modern way. Your just general comment on regulatory tailoring.
I've been a strong proponent of scaled disclosure for a very long time. I totally share your concern that we're having an extraordinary adverse impact on entrepreneurs because we overregulate and impose costs. In terms of your specific proposal to reduce the frequency, in effect replace 10Qs with semi-annual reporting of financial statements, I have some reservations, although it's possible that it would work out. Obviously, it would reduce costs, but it's also going to reduce the amount of information available to the marketplace so that it can accurately price securities in the secondary market. So on the other hand, it's not like there won't be any information, because there's 8K current reporting requirements. So it may very well work out fine. What I would suggest is that maybe we run, in effect, a test and limit it to smaller reporting companies, or maybe smaller reporting companies and EGCs, and see if that works before it's generalized.
Tailor it further. Thank you. Thank you for the input. On behalf of Chairman Brown, Senator Warner, you're recognized.
Thank you, Senator
I guess
Phillips.
I can't call you Mr. Chairman on that case,
It
Tom.
works. You're exactly right.
I was just trying to do
Phyllis always does whatever I ask. It's unbelievable.
No, that's kind of like, that's kind of a. I'm not even going to complain about the extra minute you took, Senator Tillis, but I'm going to start with Professor Jackson and talk a little bit about cybersecurity. And this is an area where I see it not only from this committee standpoint, but particularly I see it from the my chair as chair on the Intel committee. And unfortunately, we've seen a dramatic rise in cyber attacks. We've seen a dramatic explosion of ransomware payments. I'm happy that I think virtually everybody on this committee supported the bipartisan legislation to make sure we've actually got a cyber incident reporting that is now law. Only about 30% of cyber attacks are actually reported. And if we don't have mandatory reporting, frankly, not to go after the company, but to identify and share with other private sector partners, we're going to get bad things will happen. And frankly, I'm still amazed that we've not seen more Russian cyber activity against our institutions in light of the Ukraine war. Professor Jackson, I know in your testimony you touched on this, and we often think about cyber attacks in terms of ransomware, but as you pointed out in your testimony, there's actually ability that victims' stocks can actually be manipulated. Can you talk about how prevalent this practice is, and how some of these cyber attacks can move beyond traditional ransomware, and whether this is actually extending to potentially state actors?
Absolutely, Senator. Thank you. Let me make 2 points about that. First, there is significant evidence, sir, that right before it becomes public that a company has been the victim of a cyber attack, there's significant spikes in the trading and options, in particular put options, in those companies' stocks. And what that suggests to me, sir, is that there are folks out there who are profiting not just from the cyber attack, but by trading on it. And that puts us at risk, that our markets are funding the very cyber attacks that you, sir, are working so hard to help companies stop. That's a deeply concerning kind of insider trading, and this bill would stop it. Or rather, this bill would make very clear or leave no doubt that the federal courts, which have expressed some confusion about this, in fact, should conclude that trading on cyber hacked information is a violation of federal law. Let me say one other thing, Senator. You asked about foreign companies, and in my testimony today, I've pointed to very troubling evidence that insiders at Chinese domiciled firms listed in the United States are trading ahead of very significant stock price declines. In fact, we show in a new report, sir, that after these sales, the stocks of Chinese domiciled U.S. listed firms dropped more than 20%. More than $10 billion in losses were avoided by insiders at these firms by selling in advance of stock price declines. And those losses were borne by American investors. I think it's crucial that we close these kinds of gaps in our insider trading law, sir.
Well, two quick comments, and I want to get to a final question for you. One is, this amount of trading that goes on before the announcement of a public announcement of a cyber attack. And again, we give confidentiality if you report to CISA, so we don't have a mandatory disclosure requirement. Have you been able to measure and actually track that? I mean, in all my activity, I've not followed this thing. I think it's a really relevant point, but have you got some metrics around that?
Yes, sir. There's an excellent study in the Harvard Business Law Review by Columbia Law School professors Joshua Mitz and Eric Talley, studying the spike in options trading just before a cyber attack is revealed to the public. They detect a very substantial increase in that trading, and because options are levered bets on changes in the stock price, the proceeds from that kind of trading could be very substantial indeed.
Well, I think I want to take a look at that because it's an area that I'm not that familiar with. And candidly, I was at and I've looked a lot at some of these foreign domiciled companies that are trading on American exchanges. I'm not sure I was fully aware that I was not fully aware that they were not subject to the same insider trading restrictions, although I was interested to see that at least there was some indication that from China standpoint that they're going to have these firms finally audited by Western auditors, which I think is a step in the right direction. As long as I got you, Mr. Jackson, Professor Jackson, I want to just talk about how insider trading can also relate to stock repurchasing, stock buybacks. Too often I think companies, the management may end up saying, aha, we see there's going to be a downturn. Let's go ahead and repurchase stock at a discounted price. Can you speak to that? I know you've raised this issue as well.
Yes, sir. As I documented in evidence that I produced while I was still an SEC commissioner, it's very clear from the evidence that insiders at public companies increase their sales of stock in connection with the announcement of a share repurchase plan. And what I found so troubling about that, sir, is that it's a strange thing for the CEO of the company to say that the stock is cheap enough that we should do a buyback, but I'd like to sell my shares. It's not my experience that CEOs are in the business of selling their property for cheap. Because of that, it's very important that there's been some movement in the direction of forcing executives to hold their shares when they engage in a buyback. Because, sir, if the idea here is capital allocation, it's not obvious to me why that's the moment the CEO needs to profit on her shares. If the buyback is a good thing for the company in the long run, it shouldn't trouble her at all to hold her shares over an extended period. And I think proposals to that effect are going to be very constructive for our markets.
Well, I share your concern. I don't know if I'm defaulting back to Chairman Brown or Senator Tillis, but my time's been expired.
Thank you, Senator Warner. Senator Warren from Massachusetts is ready.
Thank you, Mr. Chairman. So one of the biggest threats to a functioning market is insider trading. When some market participants get special access to information, they can use it to take advantage of everyone else. It is cheating, plain and simple, and it is illegal. Even so, it happens. We've talked a lot today about one kind of market participant, and that is company executives who trade stock based on secret information they have about their businesses. But it can happen in other ways too. Sometimes a high-ranking government official might know about a change in government policy that can powerfully affect a corporation. Professor Jackson, you are one of the nation's top experts on insider trading, so let me run through some examples with you. If an official, let's say a member of Congress, learned that the federal government was about to award a company a huge new contract, and then that senator bought stock in that company before news of that contract was made public, could that be considered insider trading?
Yes, Senator, it could.
Okay, let's try another one. What about if that member of Congress attended a top secret briefing and learned that a company was facing big legal trouble? Could selling their stock before that company made that information public be considered insider trading?
Yes, Senator, it could.
Okay, and what if that member learned in a closed committee meeting of plans to boost the Pentagon's budget by tens of billions of dollars? If that member bought defense stock generally ahead of the markup, could that be considered insider trading?
Yes, Senator, it could.
Let's do one more. What if that member held drug company stocks and learned from their committee chair that legislation to cut drug prices would be moving in the committee? And if they sold those stocks, could that be considered insider trading?
Yes, Senator, it could.
So members of Congress are in a unique position to obtain information that they can use to game the stock market. In fact, the risks with government officials are even higher than they are with most CEOs, because government officials can sometimes use their positions to influence private outcomes and the values of the stocks that they hold or trade. For example, voting on laws that would protect or break up a giant tech company could have a direct impact on the wealth of a member of Congress who holds stock in giant tech companies. So look, this isn't a hypothetical problem. Last year alone, members of Congress and their spouses traded more than $500 million of stocks and other investments. And here's the most alarming part. On average, members of Congress came out ahead of the S&P 500. And yet, not one single member was criminally charged with insider trading. Now, there's no doubt in my mind that members of Congress who break federal laws by engaging in insider trading should be criminally prosecuted. But there's also no doubt that's not enough to fix the problem. That's already the law. So let me ask you, Professor Jackson, do we need stronger rules to prevent insider trading in the halls of Congress?
Yes, this is critical, Senator. When members are in the business of making decisions that can affect companies at the same time that they have portfolios that could include those very companies, there's a risk of a conflict. And we absolutely need rules to address this, Senator.
Thank you. And Professor Coffey, you are also one of the country's leading experts in the area of insider trading. Would you like to weigh in on this?
Well, I think Professor Jackson was basically relying on the Stock Act, which is a very specific statute. I would point out that with respect to Section 16 here, if this was someone other than a congressman or a person covered by the Stock Act, it might be impossible to prosecute them because there would be no personal benefit paid for the information. And then you would not be liable under this proposed Section 16 with its personal benefit rule. But in terms of the broader question you asked, I think you might be suggesting that we should move beyond the criminal law, which is always a blunt sword that can only be occasionally applied, and have Congress impose upon itself some prophylactic rules. It may be Congress should only invest in diversified portfolios like mutual funds and not own individual stocks. I've heard that idea has been suggested in these halls. I think it's a very good idea.
Thank you very much, Professor Coffey. You know, regardless of how trustworthy members of Congress might be, trading in individual stocks undermines public confidence in the markets, and it undermines public confidence in Congress. And this is why, as Professor Coffey delicately alludes, I've introduced bipartisan legislation with Senator Daines, who is also a member of this committee, to ban members of Congress from owning or trading individual stocks. They can still do the big mutual funds, but not individual stocks. We need to change the rules so that it is 100% clear that members of Congress are not going to be allowed to game the system. Mr. Chairman, I know that you have introduced legislation to achieve a similar goal, and I look forward to working with you and working on a bipartisan basis. We need to get this done.
Yes, I do too. Thank you, Senator Warren. There are two Republican senators that are trying to get online, not yet quite ready, Senator Daines and Senator Moran, no. And Senator Van Hollen on the Democratic side is from his office from Maryland. Is he ready?
I am. Can you hear me?
Okay, go for it. Senator Van Hollen is recognized.
Thank you, Mr. Chairman. I had hoped to get back to the committee in person, but good to do it virtually. And I want to thank all the witnesses for their testimony. Professor Jackson, good to see you again. And as you and I discussed in the past, I've introduced legislation called the 8K Trading Gap Act, which seeks to close a current gap that we think can lead to mischief in insider trading rules. As you know, right now, public companies are required to disclose significant corporate events to the public within 4 business days after the event occurs, and they have to do it on a form called an 8K. This could be for the announcement of clinical trial results for a drug maker. It could be the announcement of a merger with a big competitor or a big cybersecurity breach that has affected a business's customers. During this period, market-moving information is known to insiders, but not to ordinary investors. And it's a period we call the 8K trading gap. So based on your research, is there any reason to believe that executives with access to this material, non-public information may be trading within this 4-day window before the news gets out to the public?
Yes, Senator, there is reason to believe that. In a paper released a few years back with co-authors from Harvard and Columbia, I documented that there's significant amounts of insider transactions during the 4-day gap you described. And Senator, we also observe that some of the announcements that are pending at the end of that 4-day period are very clearly material corporate events, mergers and acquisitions, balance sheet restructurings, and the like, yet we see very considerable transactions. You know, Senator, when we started that study, we expected to find very little trading during this period. After all, the company has publicly said that they are going to disclose a material event. We thought that insiders would not trade during this period. We were astonished to see insider trading to this degree, and I think it points up both the need for your important legislation to address the 8K gap and the need for the legislation before the committee today that would better deter insiders from engaging in these kinds of transactions.
Well, I appreciate that. I was going to ask. You know, I understand giving companies the 4 days to report on these events, but there certainly doesn't seem to be any justifiable reason to allow insiders to trade during that period. I assume you agree based on your previous answer.
Well, that's right, sir. I can't think of one. I can't imagine why the company would want its senior management or directors to be trading during the pendency of an announcement that warrants a Form 8K.
Now, we also need to make sure that American investors are protected on U.S. exchanges in other ways. Obviously, insider trading here at home is one, but we also need to deal with foreign corporations. And a couple years ago, Senator Kennedy and I introduced the Holding Foreign Companies Accountable Act that passed into law to make sure that all companies listed on U.S. exchanges, whether domiciled in the United States or overseas, had to comply with simple accounting and transparency rules. I was just looking at a paper that you wrote recently, just in the last couple of days, I believe, on the issue of foreign foreign insiders and their insider trading and how they're not governed by the exact same rules that apply here in the United States. Could you talk a little bit about this?
Of course, thank you, Senator. Yes, building on your important legislation on the Holding Foreign Companies Accountable Act, two co-authors from the Wharton School and I just last week released a paper documenting insider trading by foreign firms that are listed in the United States. We show, sir, that these insiders, by selling before stock prices fall, avoid billions upon billions of dollars in losses that ordinary American investors have to bear. There are two important points I want to make about this new study. First is these foreign firms are exempted from the straightforward disclosure that American companies have to provide investors when their insiders engage in trading. That exemption was provided by the SEC decades ago, and I think it's long past time for the SEC to take another look at that, sir. When they provided that exemption, our capital markets were a very different place, and foreign firms raised considerably less money on U.S. exchanges. Second, it is troubling that these foreign insiders are able to sell in this way, and the disclosures that they're providing are provided in paper to the SEC under long outdated rules under what's called Rule 144. The idea that there are paper filings sitting in a cabinet at the SEC, sir, with this kind of important information, we've got to fix that. And so I'm hopeful that I'll be able to work with both all of you on this committee and at the SEC to get these rules tightened up to deter foreign insiders from trading in a way that is unfair to ordinary investors.
Well, thank you for highlighting this issue. Based on your investigation, we are working on legislation to close that unfair situation, and look forward to being in touch with you about it. Thank you.
Thank you, Senator.
Thank you, Senator Van Hollen. I believe that no one else is returning we're voting on the Supreme Court today and voted on a high-level HUD nominee. So I think I will turn to Senator Toomey for some last remarks, and then I'll wrap. Thank you.
Thank you, Mr. Chairman. I just would like to ask unanimous consent to enter into the record letters and statements of support for Jobs Act 4.0 with more than 20 industry and taxpayer advocate associations, including but not limited to the Small Business Investor Alliance, Managed Fund Association, Securities Industry and Financial Markets Association, National Venture Capital Association, BIO, Small Business and Entrepreneurship Council, AFP, Club for Growth, and the Competitive Enterprise Institute.
Thank you, Senator Toomey. Thank you all to the witnesses today. I'm submitting a statement without objection, so ordered his request. I'm submitting a statement for the record by the Maryland Securities Commissioner, Melanie Center-Lubin, President of the North American Securities Administrators Association, without objection. For senators who wish to submit questions for the hearing record, those questions are due 1 week from today, Tuesday, August 12th. To the witnesses, please submit your responses to those questions within 45 days of receipt. Thank you again for your testimony today. The committee is adjourned.